Hi traders, here we are looking at the S&P 500 E-mini futures on the daily, 4-hour and the 1-hour time frame. Which direction should we be taking this trade based on this time frame correlation analysis? And also, what is the stretch principle that can put the probabilities in our favor? This and more in this trading video. Hi traders, thank you for joining the Master the Markets team in our live trading session video today and supporting us in our mission to spread the truth of trading and help you achieve consistent performance. It is Tuna upon here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So here we are traders on the daily time frame over here. This is currently in uptrend at the moment as signaled by our smart money indicator. Bottom to top move is what we call it over here, and you can see the top is not being confirmed yet. That's a potential top. It is quite a large move over here on the daily time frame. Open equity is low. There's a higher probability that that potential top will turn and it will confirm to become a confirmed top with an arrow and a dot on whichever bars that fulfill the formulas. Now, taking a look on the 4-hour and the 1-hour, the 4-hour on the other hand, you can also see that in terms of the trend wise, it's an uptrend at the moment, but it's a phase two, so it's a counter trend part over here. So on the daily time frame, it's a uptrend phase one. On the 4-hour, it's an uptrend phase two, and on the 1-hour, when I look at it, and I'm very soon going to be correlating that with the volume spread analysis trend indicator as well. What we can then see over here on the 1-hour, that would be a downtrend is what we are looking at the moment, is it not, traders? So that's what we have at the moment. Let me just put my smart money indicator over here as well. And once that loads up, then we can also take a closer look on that as well. So over here, if you can take a look over here in terms of the trend on the 1-hour, let me just take a look at that. In terms of that, that's what we have at the moment. Taken out that low, so it's still a downtrend over here. And what we have at the moment, do we actually have a confirmation? No, it's a downtrend phase one. So when I correlate all of that together, let's take a look at this. So when I correlate all of that together, so on the daily time frame, it's uptrend phase one. On the 4-hour, it's actually uptrend phase two, so signaling a downside, and over here it's a downtrend phase one, so down and down over here. And then on the daily time frame, it's on the upside, so this two signaling that it may push the higher time frame into a downside, isn't it? Ripple to swell to a wave.
If you're enjoying this video, go ahead and smash that like icon. If you haven't joined our channel yet, click on the subscribe button and hit the bell icon so that you get notifications immediately when we post up quality content like this, and especially to get our live trading updates sent directly to your phone.
How do I put the probabilities more to my side? This is what I want to talk to you more about on this session, which is the stretch principle. So what is the stretch principle? The first thing I want you to understand in the stretch principle is, traders, if you look at the old Chelsea bar, there is in any of these bars, whether it's candlestick or old Chelsea's, in vertical bar charts, and most traders all be vertical bar charts. If you take a look, in a vertical bar, there will be 2 points, right? High and low. Is it not, traders? Now, if I put one more line into here, which is on the left hand side, which will be a open, right? Let's ignore the close for now. If I put the open, then immediately what happens is that the bar gets segregated into two parts, isn't it? From the opening price. So there's one part which is the smaller range from the open, and then there is the another part which is the bigger range from the open, which you can see over here. Is it not, traders? Yeah. So there's one part which is a smaller range, and the other one is the bigger range, which is also, you can call it as bro, right? Which is one, as one of our Vedanta elite members have called it. Now, if you focus on the smaller range from the open, the smaller range from the open. So let me just put that in here. The smaller range from the open. Now, that is also known as the nearest extreme to the open. Okay. Actually, before coming to that, let me tell you this thing over here. The smaller range from the open, as I said, is also known as the nearest extreme to the open. In other words, is also known as the stretch. Now, this is, I'm just borrowing one of the slides from one of the conferences that we did on Round the Clock Trader. Now, this is, the stretch is also known as the nearest extreme to the open. Okay, also you can call it Neo, right? Like in the Matrix character Neo, Keanu Reeves played that. Now, so you can either call it the nearest extreme to the open, you can either call it the smaller range from the open, or you can call it the stretch. So they're all the same thing. The stretch principle got very, very popularized by this very big trader called Toby Crable, which you can Google and search. He's a very big hedge fund, billionaire hedge fund trader based on this stretch principle. Okay. Now, as traders, what you want to do is once you've identified on a higher probability where the stretch is formed, then what you really want to capture, traders, is the bigger range from the open. Okay. So we want to be looking at that on the lower time frames. Okay. And then we want to capture the bigger range from the open. That's what we are looking to do using this principle and methodology. So let me show you what we actually look at. So delving a bit deeper onto the stretch principle. Remember, the only time when you won't have a stretch or a smaller range from open or a bigger range from open, when do you think that will be? Yes, some of you would have got it. It's when the open is right smack in the middle. That's when we won't have any smaller range or bigger range, isn't it? It will be just be equidistant, and that usually happens very less of the time. Most of the time, traders, when we got a red bar, a seller bar, usually the stretch is to the opposite side, to the upside. And when we got a buyer bar, usually the stretch is to the downside. Just like what you can see over here. If you take a look at this, the stretch is almost so little right over there, as you can see. And then if you take a look at the red bars, then you can see that the stretch is to the upside. Okay, that's what you are taking a look at. This one is almost, there's no stretch, very little, very little. That's what we are seeing. Now,
For those of you who are unsure of any of the terminology or the concepts in this video, watch our free Trader Starter Pack 5-day video course as shown in Empire Cinema. It is educational, entertaining, and covers basics and advanced content with cross-transferable principles for trading and investments. It pertains to both beginners and intermediate traders, all dedicated towards helping you achieve consistent performance. Go ahead and register for it on the link below.
how do we then use all these stretch principles and correlate it onto the lower time frames? Let me show you. So as you know, the stretch is the nearest extreme to the open, right? So what we do is we, just like average range, we take a look at what we call the stretch 10. So we take the stretch, average stretch over 10 bars. So on a daily time frame, that will be over 10 days. So what we then take a look, not at today's bar, so we take a look from the previous bar. So we take this bar, for example, we take the stretch of that. So for example, if I were to calculate the stretch of that, then that would be the high. I can read it from here. The open, the high minus the open, 4173.5 minus 4172.25. So that's about 1.25, isn't it? Yeah. So like that, just say 1.25. And then for here, then the stretch is to the upside here. Let's say that's 3. Let's say I'm just doing it roughly. This is the stretch to the bottom 2. So like that, you keep adding them all up for 10 bars. So you sum them all up for 10 bars, all the stretch, and then you divide it by 10. Then you will get this average stretch number, okay, X, right? So the good thing is we don't need to keep doing that. We can put that indicator on there. You can find it on TradingView. It's called the average stretch. Okay, so if you go on the indicators, you can just type in technicals and you can just type in stretch and then you can just find the average stretch over there. Okay, right. So once you've got that, you put it onto this chart and that's over here on here, right? The stretch 10. And once I place my cursor on the previous day's bar, that will tell me the number, which is about 10.48. Okay, let's just say 10.5. Okay, let's just say 10.5. Now, once I got that number, I can go on to a lower time frame. Let's say I take the 4-hour time frame. Okay, the 4-hour time frame. And what I then do, I overlay the opening price first, which is this one here, 4153.75, which is the same as my, of course, my daily time frame, the opening price of this bar over here, which you can read 4153 as well, 4153.75. So I'm just correlating that. Of course, you've got to be the same across all time frames. Now, this green line, vertical line, is where the day starts from, okay, for this day. So from then on, I got all these bars that I formed, okay, 14, 15 bars whatsoever. But the thing is, follow me so far. So this is the opening price, okay. Now, what is this green line and red line which I've drawn equidistant to the opening price? That is my stretch 10 number, my average stretch number which I got from the daily time frame. So that is, how much was that? 10.5, isn't it? So what I do is to 4153.75, I add that 10 number, okay, on top. I just for simplicity I've just done 10 points to the top and 10 points to the bottom. So 4153 plus 10 is 4163 and 4143. So these are equidistant. So these are the stretch lines. Now, how do we then use this? So basically, if you can see, we wait for where, what am I looking for as a trader? I'm looking to see in which direction is my bro going to form. Okay, if my bro has a higher probability to the downside, then the stretch is been set to the upside already, isn't it, traders? Yeah, that's what I'm really looking for. So over here, what's the first cue that we look for at the equidistant line? Since the equidistance lines is the average stretch number, so to whichever direction that the price takes that stretch number out, which is now here towards the downside, you see it broke out from the lower stretch line, right? So you took that out. So what does that mean? That means price from its open, right, has stretched further down, okay, has extended further down and has done about, which I've written over here, 18.5 points to the downside. In other words, it has broken its lower stretch line. Therefore, there's a higher probability that the BRO is going to form to the downside. Okay, that's how we use these stretch numbers. All right. I think for today, what I will do is, and to the upside, it has done 7.25. That means from the open to the highest point, which is here, it's done 7.25, and from the open to the low, it's done 18.5. So overall, it is done about 25 points, and that's what it has done for today. That's how the breakdown is. So the stretch is 7.25, and it's done its BRO to the downside. In the next coming videos, as I will be doing this more, I'll go more in detail on the other parts of the stretch principle strategy. This will also make you more understand on how we trade and how you can also use it in your own trading as well. But for today, your main takeaway message is that the stretch principle is the smaller range from the open or the nearest extreme to the open. And in today, that has formed to the upside highly probably, and the BRO is to the downside. And basically, if I were to summarize all of these bars, the 1 hour time frame into one bar on the daily time frame, basically from the open, it's gone up this high, that's the highest point, and it's gone down this low to the lowest point. And that is exactly the bar that you are seeing on the daily time frame forming at the moment. So this is this bar here that is forming over here, okay, of all this. So let me just move that more to the right hand side. So from this green line, vertical line onwards, this one bar is what you're seeing from this green vertical line, all these bars being formed to the right hand side. Okay, so if I would extend that a bit more, and you can see that more clearly. So that one bar is what is being formed onto here, and then that is then correlating into your stretch from how it's moving from the top then to the bottom. All right, traders, I guess that's enough for today in terms of this correlation and this analysis. This will make a bit more sense into how we are trading, how we are posting our ideas, how we're doing our analysis. It's a very strong, powerful principle stretch. It makes much more sense on how a bar is formed on the daily time frame, and then how you can correlate it onto the intraday lower time frames, and how you can use this in any strategy that you formulate and create according to fit to your own personality. All right, traders, I guess that's pretty much that from me on this video. Just do reflect on this, look at it quite a few times, and then if you got any questions, then you can always message us privately on Trading View. Okay, all right, traders, that's pretty much that from me. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.
If you want to get notified every time we put a video up, especially on our live trading update videos, hit the subscribe button and turn on the bell notifications icon. This will get the YouTube algos to kick in and for you to join us in our mission to spread the truth of trading further, so that traders like you can benefit from our videos to trade like a master, achieve consistent performance, and change lives.